Hi, in today's video I'm going to show you why we need to eliminate the investment asset when we're doing a consolidation to avoid some double counting. So I've got some basic facts here. Parent acquires 100% of sub on the 1st of July 20x5. It cost them $1 million, and for that they purchased 100% of the share capital and retained earnings that totalled $800,000. Therefore, they paid goodwill of $200,000. So when we do the consolidation accounting at 30 June 20x6, which is 12 months after the acquisition, what we realise is that we're measuring the goodwill at the acquisition date, but the consolidation is performed at the year end. That's when their reporting period is. So it's been 1 year since the acquisition occurred. Let's have a look at the consolidation worksheet and see why we need to eliminate that $1 million investment asset. So some assumptions about the worksheet that I've created. Both parent and sub trade independently of each other, so we don't have any intragroup transactions to eliminate post-acquisition. And that the invented numbers that I've provided for you in the trial balance is what we need to be using to prepare our consolidated financial statements at 30 June 20x6. Okay, here's my consolidation worksheet for the year ended 30 June 20x6. I've got a column for parent, a column for sub. Then I add the two together. Here's my consolidation journal entries to records, debits and credits, and then to the right here, that's where my trial balance sort of comes in as that final column, which is row I or column I. So remember, it's been 1 year since the acquisition, so there's the parent's profit, there's the sub's profits, no intragroup transactions to eliminate, so our consolidated profit for the year is the 1624. The focus here really though is just how we need to avoid that double counting and what it does for us. So parents got the $1 million investment. Remember, there's goodwill of $200,000. That's caught up within that asset balance, within the general ledger value. In sub's trial balance, you'll see there's the share capital and the retained earnings at the acquisition. So we need to get rid of those, because there's $800,000 in equity on one side of the balance sheet. When we look at it, if we add all of our figures across in this column, and then they're caught up, they're represented in this investment, because remember, the $1 million paid for that $800,000. So down the bottom here, you'll see here's my elimination of investment asset entry. I'm reducing my asset to zero by crediting the investment $1 million, debit the share capital, debit the retained earnings at the acquisition date, and recognise the goodwill of $200,000. So by doing that, you'll see that the balance over in my consolidation column is zero for the investment asset, and the goodwill gets recognised of $200,000. So that's what we want to see. And then down in the share capital area, the $2 million is just the share capital of parent, because sub's $500,000 has been eliminated, and the opening retained earnings at 1 July, they're only those of parent, because at the very beginning of the period, that's when we acquired sub. So sub wasn't part of the group until this date, so it hadn't contributed any profits. If I don't do that consolidation entry, I'm going to be double counting. So in this column K, you'll see if I didn't do that elimination of investment asset entry, I wouldn't be showing separately the goodwill. I'd still have the investment asset, and what that would create is that my total assets would be $800,000 higher than if I'd done that entry, and therefore my net assets also overstated by $800,000. On the equity side, again, it would be $8,424,000 compared with the 7.6. So again, the equity side would be overstated by $800,000. And importantly, you'd see that the opening retained earnings would be suggesting that the sub had contributed retained earnings to the group when it hadn't. It had only just been bought at that date. So that's why we need to eliminate the investment asset, and what we can see that entry permits is that post-acquisition profits come through, which is the profit that sub made for the year, because that's all post the acquisition on the 1st of July X5. So those profits flow through to our consolidated column. And that's sort of one of the key purposes of preparing consolidated financial statements.